Okay, so today, before I get into the details of this particular loan, I want to let you folks who are thinking about becoming a mortgage loan officer or who have recently become a mortgage loan officer know that I have not only hired, trained, and managed close to 100 loan officers, but I have spoken to hundreds more. And the folks that I speak to who have been in the business 5, 10, 20 years, almost to a person, tell me that they can now look back with the experience that they have, and they let underwriters deny loans that really could have been approved. And when they were newer, they simply didn't know enough about the guidelines to be able to push back. And so they turned the loans down. They let the home buyer or the home refinance person go away without the loan after they paid for their appraisal, et cetera. So in this particular loan, it was an attempt to do what's called delayed financing. And most you probably know delayed financing is a way for someone who has paid cash for a property to get a mortgage and take cash out of the property, but with a separate set of rules than the regular cash out guidelines. And what happened here, this loan was going Freddie Mac. Fannie Mae has this program as well. Very similar, not exact guidelines. The loan was going Freddie Mac, and the person had bought the property for cash a little over 6 months ago. We were looking in month 7, month 8 of ownership. And the underwriter came back and denied the loan. They said that because they hadn't bought it within 6 months for delayed financing, they couldn't take cash out until a full year had passed. They said that the Freddie Mac guideline would not allow for any cash out until the property was owned for at least 12 months. So I was able to help the person go back to the underwriter and point out to the loan officer first, the underwriter was correct and that this technically was not delayed financing, because delayed financing only takes place within the first 6 months of ownership. However, the requirement that Freddie Mac had to not allow any cash out within 12 months was based upon when you're paying off an existing first mortgage. And in this case, there was no first mortgage because they had paid cash for the property. And therefore, the regular Freddie Mac cash out rule of one or more of the borrowers having to have been on title for at least 6 months from note date to note date was satisfied. And therefore, the loan officer was able to go back to the underwriter and get the loan approved and taken out of denial status. While we're here today, I am going to tell you about one other loan that was submitted into underwriting that should not have been submitted into underwriting, that ended up being, most likely is going to end up as a denial. And that was an FHA mortgage. They had AUS approval. There are several reasons that even though you may get an automated approval, that an FHA mortgage has to be downgraded to a manual underwrite. And manual underwrite comes with stricter guidelines, especially on the debt to income ratio that's allowed with automated approval. In this particular case, the reason that caused the downgrade to the manual underwrite was that the business income had decreased by more than 20% on the 2023 tax return versus the 2022 tax return. And the problem, or where the loan officer made their mistake, was that the gross income in 2023 was higher than the gross income in 2022. It was the net income for 2023 that had decreased by more than 20% from 2022. And there had been some one-time extraordinary expenses. So without clearing the path before sending the file into underwriting, the loan officer just assumed that everything would be okay because the gross income had increased. Now, I have never heard of FHA agreeing to use the gross income instead of the net income. I have never heard of FHA underwriter agreeing to use like the one-time unexpected expense as a justification for the decrease to let the automated approval live and not require the manual underwrite. And I know this person had also gotten some advice that possibly using the year-to-date profit and loss statement to maybe work in some sort of a longer-term average to get the decrease less than 20%. Now, the year-to-date profit and loss statement was needed because more than a quarter had passed since the tax return was filed. But again, I have never known of an FHA underwriter to agree to overlook the 20% drop in net income from one tax year to the next. There was no way around it. And while I haven't heard back from this person yet, I'd be very surprised if that family was not hurt by this decision, this lack of attention to detail by the loan officer, and the lack of attention to detail by the loan officer's management and ownership, which we unfortunately see a lot today. Since the pandemic, it's now regulatorily accepted in most places, if not all places, that a loan officer can work from home. It used to be you really couldn't work from a home office. That office would have to be licensed, but now during the pandemic, that was relaxed. And we do see almost universally newly licensed loan officers all working from home, nobody to check with. Yeah, they have a scenario desk if they know to ask. Yeah, they might have a training area if they know to ask, but nobody is looking over their shoulder, and they just don't know enough to see where the pitfalls could be. So if you are either a newer loan officer or you're hiring and training new loan officers and you would like them to have a very serious junior, senior level college class in how to properly underwrite and structure mortgages, you can reach out to me, Alan, ALAN, at complete1003.com, or you can just go to the website, complete1003.com. I like talking to folks in the mortgage business, whether you're a newer person or whether you're an experienced person. We can have a good discussion about how to help these new loan officers close more loans with less bumps in the road. And we'll see if I can help you out to make sure that the loans you send into underwriting actually qualify to close.